About nothing. And the market is still churning. You listed 72 homes yesterday, which is fantastic. And we've got 20 days of inventory. We're selling 129 homes a day. I think by next week, it's going to be 130 or maybe over. So we'll see. Last year was 148 sales a day. And I don't think we're going to beat that record. Last year was a record year. And we were selling 148. That's amazing, isn't it? And we sold over 50,000 homes last year and another 12,000 new homes. So we'll see what happens this year, but I don't think we're going to hit that 62,000 mark. We shall see. We talked yesterday about how our population is going to continue to grow, and the different projections different people have. Right now, we're growing about 5,000 new residents a month. They say that's going to go down to 3,800, but I don't think that should stop your marketing efforts by any means. We're still in an incredible market here in Las Vegas. So the investors are still coming into the market, buying 45 properties a day. And I don't see that ending because I did some comps yesterday for a rental house. And I was just amazed. I mean, the current people that are moving out were paying $1,500, and it's going up to $1,800. So after just a year and a half, I think that was. So anyway, investors are going to continue to come into our market, and we talk a little bit about using Remind and perhaps Vulcan 7, other ways to get investors. If you have listings that particularly condos or single family homes that can rent in that meat of the market, which is now about 1,800, you should start perhaps thinking of the second half of the year and maybe marketing to get investors. I'm sure people in California who are bringing their money here are going to buy a home, but maybe they would want to buy a investment home too. So don't, just let your imagination roll in some of these things because our market is going to continue. I want to talk a little bit today, though, about interest rates. Let's see. I love it when that happens. Where's my fella here? Went backwards. Hold on, there he is. There he is, Federal Chairman Jerome Powell. He testified before Congress in September, that the rates were going to maintain under 3 and under, through 2023. And now we have reasons that it isn't. And that's the war in Ukraine along with inflation. So, when you spend all that money and people have more money to buy more things, inflation happens. I mean, we just printed money, so we caused our own inflation, or the government did. So here's what they say on Inman News. They say, having wound down its $120 billion in monthly purchases of mortgage-backed securities and treasuries, the Fed has signaled that it wants to start letting those assets run off the books. Yeah, so that's going to cause the rates to rise, of course. Powell reiterated Monday that the Fed might decide to start shrinking its balance sheet as soon as its next meeting in May, though that is not a decision they've made yet. The trick for the Fed is to tighten monetary policy enough to lower inflation without causing a recession. And that's a powerful sentence right there. It's a trick. And that means they don't know how they're going to do it. They didn't say the method. They said a trick, meaning that they're going to have to try a few things to tighten the policy, lower inflation, and not cause a recession. So you need to listen to that loud and clear. The Fed is currently projecting a soft landing for the economy, Powell said, with inflation coming down and unemployment holding steady. Growth slows as the very fast growth from the early stages of reopening fades. The effects of fiscal support wane and monetary policy accommodation is removed. That's a big sentence, and I'm not really sure what it's saying. It's saying that growth slows as the very fast growth from the early stages. Okay, fine. So, what they're saying is the growth is slowing. I don't know why they just don't say that, but they talk in a different language sometimes. And it also says that some have argued that history stacks the odds against achieving a soft landing. and point to the 1994 episode as the only successful soft landing in the post-war period. And Jerome Powell acknowledged that. I believe that the historical record provides some grounds for optimism. Soft, or at least softish, landings have been relatively common in the U.S. monetary history. In 3 decades, 1965, 1984, and 1994, the Fed raised the federal funds rate significantly in response to perceived overheating without precipitating a recession. So evidently they've done it before. And the trick about it is, it's everything has a different reason. So in a forecast issued Monday, economists at the Mortgage Bankers Association predicted mortgage rates won't climb past 4.6% over the next year. Okay, so we've heard this before, right? They're not going to go past 3% by 2023, and now we're not going to go past 4.6%. So we'll see. In a March 10th forecast, Fannie Mae economists said they see rates stabilizing as closer to 4. So meaning that even though it's jumping up, it might go back down. And this is the mortgage rate forecast and how differences are. Fannie Mae is looking at 3.9, and the Mortgage Bankers Association is looking at 4.6. So somewhere in between there, they'll probably land. And then mortgage rates approaching 5% threshold. This is just showing you that the 30-year conforming is up there pretty close, right around 4.6 plus. And the 30-year jumbo is up there over 4.5. And the 30-year FHA is lingering there under 4% or right around there. So we shall see what happens. In any event, like I said yesterday, you need to get your calculator out. You need to look at our median price home, which is headed up to 458 by the end of the month. We shall see. But anyway, get your calculator out and see, based on these different scenarios, what the increase is going to be, so that you can say, well, when it was at 3%, and with the home that you're looking at, it would have been $200 a month less. However, because of appreciation and other factors that you're going to mention to them, giving them a reason to buy regardless of the rate increase. And honestly, 5% is not bad. When John and I got into real estate, believe it or not, 18%. Yeah, and then it went down to 15%. Yeah. So if you want to sell in that kind of a market, you get real creative. And so do sellers. A lot of seller carrybacks back then too. Because people wanted to move on. So that is it for the mortgage rates. And then we have another topic today, and that's inventory. I had the pleasure of meeting with some people yesterday in the title industry, and we talked about, the shortage of inventory. And I keep spreading my my words, which are, there's not a lot of inventory because we keep selling so many homes. The inventory does come on the market, and then there's enough to sell. So we're selling, we're selling 129 homes a day, but we couldn't be doing that if we didn't have inventory to do that. So it comes on the market and it goes. So the shrinking supply of homes on the market has been a key driver of skyrocketing housing costs in markets across the nation, with just 729,000 homes listed for sale in March. That's across the United States. And that's according to the Zillow listing data. So all but shutting out first-time homebuyers and sending rent costs through the roof, as renting becomes the only option for many Americans, making saving for a down payment even more difficult. And again, I would go ahead and figure out what price home somebody can end up with a payment of $1,800 to $2,000, because when you rent a home, you got to put that $1,800 down for the security deposit, then the cleaning deposit, and any other fees that the homeowner or property management company might be charging. So you need to look at FHA, look at the payment, and maybe get with your lender and get some scenario going so that you can perhaps keep some of these first-time home buyers in the market, especially millennials. Millennials are coming into the market. So we can't overlook the fact that, don't be just a naysayer and say, oh, I'm not going to mess with them, because I think there are some first-time home buyers out there that can afford it. Anyway, with the share of first-time home buyers dropping from 45% in 2019 to just 37%, and then 26% of experts polled by Zillow pointed to 2024, while 25% pointed to 2025 as the year they expect the share of the first-time home buyers to return to the 2019 levels. Well, 2019 was not a bad year for first-time home buyers. And if people are going to want to buy homes, we're not dropping off the cliff here. And so I think sometimes these writers, these reporters, for sensationalistic purposes, make it seem like the sky is falling when it really isn't. In the immediate future, experts predicted home values and rents to continue trending upwards, with Zillow economists predicting a 16.3% increase in typical home valuations between February and December of 2022. They're right there. That's good. That's a golden statement right there. So if I was a first-time home buyer and I thought, well, if I buy a $350,000 home, or let's make the numbers easy, let's say 300, and it's going to increase 16%, I mean, that's $48,000. Think about it. So why wouldn't I go borrow from my parents or figure out how to get that down payment so that, I can be part of that big swing of home equity? I mean, that's amazing. That's appreciation. So I would definitely use that when I would be talking to prospective home buyers. This article by Ben Verdi goes on to say, against the backdrop of tightening Fed policy, which we just went over, and increasing mortgage rates, which we just saw, the more bullish outlook for home value suggests that home inventory shortages will remain the dominant price driver this year. And again, I don't like that verbiage. They need to say why there is not a lot of homes on the market. It's not because nobody's buying them and nobody's putting them on the market. It's because people are buying them. I think it sends a negative message. I don't know what you all think, and you can comment below if you would to let me know what your thoughts are. Now, Terry Loeb says, Paulsonomics founder, I guess he wrote that newsletter. He says in a statement, if price increases this year for homes, rents, energy, and food each exceed wage growth, as the panel expects, home affordability challenges will intensify further, especially for low and moderate income renters. And again, I think you need to play the equity card, the appreciation card, when you're talking to these buyers. And these people aren't in the market like we are every day. So take that as a grain of salt sometimes with what they say. That's how I feel anyway. Let's see, where are we here? So the inventory crisis, again, it's not an inventory crisis. Gripping America housing supply will most likely let up in 2024. Oh, well, thank you. With some experts forecasting a longer wait, according to a survey released by Zillow. And I just disagree, but we're all entitled to that opinion. 38% of housing market experts polled by the listings portal Zillow believe that the housing market will return to 2019 levels by 2024, at least in terms of metrics like inventory and the share of first-time home buyers in the market. Zillow said that in a news release. Okay, fine. Inventory and mortgage rates will determine how far and how fast home prices will rise this year and beyond. Senior economist Jeff Tucker said in a statement, we are seeing new listings returning to the market slowly as we enter the hottest selling season of the year. But this supply deficit is going to take a long time to fill. Total inventory has fallen from a monthly average of 1.6 million units per month in 2018 and 2019 to just over 1 million per month in 2021. While 38% of experts polled expected 2024 to be the year total inventory returns to 2019 levels. 36% were more optimistic, marking 2023 as the year things would settle down. Who knows at this point, between how the war in Ukraine is going to affect us and how interest rates are going to be affected by that, how the Fed is going to control inflation. So I just don't think it's as black and white as some of these the Zillow senior economist Jeff Tucker might think. And again, you and I are in the market, so we're the ones that really have our finger on the pulse. And like I said yesterday, there's more money in the United States right now in the banks and in people's savings accounts and their checking accounts and in their home equity than we've ever had before. So there is money here, and sometimes this is just something I think about. You know, is the government causing inflation because we have money? And they want the money to be spent in the economy. I mean, I am not an economist by any stretch of the imagination, but you live long enough and you see some patterns over time, and it seems to me that there's more play than what maybe Zillow thinks or Inman thinks, some of these other people. But we shall see. We shall see. We'll hang on and see. So that's all I had time to prepare for today, but I do want to say that this afternoon, Jimmy is doing his Show Me the Money class, which I love. It's ethics. And we had an ethics class a week or so ago, which was totally different. That ethics class talked about, your own ethics and how you determine, what your ethics are, and were you born with your ethics? Anyway, this class is totally different. This class addresses being ethical in your in your dealings with your buyers, sellers, and other agents. So it's really an interesting class, and Jimmy always has new relevant information to share, and along with what's going on in the market and how we should treat each other. I mean, we started doing that over a year ago with the multiple offers, and yes, they call it the acceleration clause. I call it the escalation clause because it's an escalation clause, really. The mortgage, when you have a mortgage acceleration clause, that means if you sell the home, you owe everything. And I don't think that's what we should be calling the clause in our RPA. I think it's an escalation clause. I'll escalate the price this much if I can get the home. But anyway, we talk about things like that. And we talk about, how to handle multiple offers and how to present an offer, even when you're up against cash buyers. 45 homes of the 130 approximately that we're selling every day, which is 1/3 of them, are investors, and most of them paying cash. Anyway, please join up. You can sign up to the class. I think Kane will take them to about 1:50 p.m., 10 till 2. And if you want to come into the class, that's fine. You don't have to sign up to come in. But the class is $20, so bring your $20 bill with you or a credit card. Anyway, I hope to see you today, and you have a beautiful day. It's Thursday, which means tomorrow is Fun Friday. I love you all. Give me a like, give me a subscribe, and I'll see you tomorrow.